Right. Well, welcome to we're week 8 now, near the final couple chapters here of the course for ARN 56. And tonight we're going to be covering 2 chapters. Hopefully at least the first chapter was on chapter 9 was fairly easy reading on transferring financial risk, and then we'll go into chapter 10, which is transferring hazard risk to the capital markets. And there's hopefully you probably saw the connection between the financial risk aspect as we talk about this. In many ways, our investment, hedging, those type of things is what we're talking about when we talk about financial risk. And then the hazard risk is something that's a little more challenging, and that for most people to understand is the securitization and derivatives and how do those things work and why is it important. I guess when you think about the whole course now, 56, as we've gone through this whole thing here, is we've really gone to the idea of self-insurance, or what is insurance for, as the basic premise, and looking at large or high deductible programs, and you have some hybrid models, and then you go to a captive, and then there's retro rated insurance programs, and eventually now we're basically to the point we're talking about some of the alternative risk financing techniques, and most of these techniques are probably going to be really for your much larger organizations, or really insurance companies will be looking at that on using some of the catastrophe models and things like that. So from a testing standpoint, again, I always stress the 50,000 foot levels to understand why you would want to use this, or why is this important to understand as a risk manager. There's not an expectation that after taking 2 chapters that you're going to be an expert in doing this. But the idea is to understand that it's out there and it's an option, and how would this work if someone brought this up to you, or how would it be applied as a technique that may be something you would consider. Now, most of the time what's going to happen is if you were going to consider some of these things, you would have either your brokerage firm or some other type of independent insurance specialist would be helping you in these type of areas. And then also I think you'll find as we get into chapter 10, hopefully it'll make the mortgage crisis more relevant to what happened, and also see the impact that essentially insurance-linked derivatives and derivatives in general. So when people talk about credit default swaps and things like that, whereas probably 5 years ago no one really knew what that meant, hopefully by reading this chapter, it kind of made more sense of what we're actually, what the whole thing, how the meltdown happened, and what are some of the disadvantages that kind of mentioned in the textbook. So we'll get started on chapter 9, transferring financial risk. Now, again, this is a fairly short chapter, just to get our feet wet on when we talk about transferring financial risk. So there's different types of financial risk. We need to be able to identify those and describe them. Explain how an organization can use derivatives, such as forwards, futures, options, and swaps, to transfer financial risk. And then explain how an organization can use securitization to transfer financial risk. And finally, given information, recommend ways to transfer the risk based upon the scenario that's provided. So really what we're looking at is, explain, how you'd be able to use these different types of forwards, and hopefully I'll be able to provide some good examples of how that basically works. So when we talk about financial risk, what are we really talking about? In the definition in the book, a financial instrument is a check, bond, or a share of stock or other of monetary value. Or in some cases, it can be a binding agreement between parties for payment of money. So when we think about a financial instrument, so I'm going to write a check to you. How do I know that check is good? You're buying stock in a company, or if you buy, again, a bond or some type of, you're buying a financial instrument that says at some point I'm going to get money back, I'm going to earn a certain amount of interest, that's essentially some type of contract that says I'm going to possibly earn money, or in the case of stock, there's a potential to lose money of what the principal might be. And so when we talk about a financial instrument, everyone basically has a role in that. At some point, people either write checks, or there's bonds that are issued, whether they're municipal bonds for public entities, or, of course, as from a private sector, now we're looking at shares and purchasing those type of things. So when we talk about financial risk, we're really talking about the uncertainty related, to the market forces on the financial assets or the liability. So when you think about bonds, interest rates, that has an effect on the value. Stock markets, the volatility in the stock market can affect someone's 401k, it can affect their retirement, it can affect an organization's pension. So when we talk about financial risk in this context for this chapter, we're really looking at what are those things that can have the potential to make something go down or something go up from the value of what that financial instrument is. Now, typically with a check, hopefully, that's not really a value that's going to go up or down. But for the most part, we're talking about bonds and shares and hedging as we get into futures contracts, things like that. Those are all pieces of paper, essentially, or contracts that are, for the most part, financial instruments that we're going to be talking about tonight. So the key categories when we talk about financial risk that they're going to break down, and this is really the part to understand is on this is market risk, credit risk, and price risk. So, again, it's a list. Anytime there's a list, most likely there'll be a question at 50,000-foot level. So when we talk about financial risk, what are we talking about? We're really talking about market risk, credit risk, and price risk. So when we talk about market risk, what exactly is market risk? From the book definition, uncertainty about an investment's future value because of potential changes in the market for that type of investment. So when we talk about market risk, most people, if you think about the stock market, that's kind of what we're talking about is market risk because the value can go up and down. Well, if you think about what happens, from a market risk standpoint, whenever the Fed comes out and they say whether they're going to extend, continue interest rates as they were, are they going to continue the quantitative easing? All those things are really part of the market risk. And so when they talk about interest rates going up or down, that's the interest rate risk, which is the security's future value will decline due to changes in interest rate. So if the interest rates, and this is where when people talk about whether you should buy your position in bonds and stocks, because typically as one goes up, the other is going to go down, based upon how interest rates are fluctuating. So interest rate risk is considered to be a part of market risk. So the challenge that you're going to have on this chapter is just to remember that what falls under market risk. So under market risks, there's interest rate risk, exchange rate risk, and liquidity risk. So those are all part of market risk. So even though there's the three main categories, you have to make sure you categorize these other kind of subcategories under market risk. So there's also what exchange rate risk. So again, if we have money in an instrument, it's uncertainty due to potential changes in exchange rates between currencies. So if you think about when they talk about the dollar and the yen and the euro, it's the buying power. Whether we have a strong or weak dollar, that's essentially exchange rate risk. So if you watch the money shows, this is something that's part of that. And the reason why that's important is because it's how much do our products cost when we're trying to sell them, or what are we paying for those products that are being brought into the U.S. So last year went to Europe, and basically everything there was twice as much money because of the position of the dollar. That it takes a lot more dollars to pay for to have 1 pound or 1 euro, which makes things more expensive. So exchange rate risk is going to be part of that. And then liquidity risk is the risk that an asset cannot be sold on short notice without incurring a loss. And so when we talk about, again, market risk, is that within there, if you kind of think about a stock or even a bond or some other type of, I'm trying to think of a short-term type of a CD. Okay, typically you can buy a 9-month CD or a certificate of deposit. Your liquidity is you're tying up those dollars at that point in time for a certain amount of interest. And of course, the longer you have that note, let's say it's a 5-year CD, well, you're going to get a higher rate of interest. So that's the benefit. The downside of having that longer wait time is that you can't, in order to liquidate, if you need cash now, you're going to incur a penalty to basically be able to pull that money out. And so that's what we talk about liquidity risk, is being able to, the ability to transfer those instruments into cash on short notice without necessarily incurring the type of loss. So those are all types of market risk. Now, credit risk. Credit risk is risk that customers or creditors will fail to make a promised payments as they come due. And that's essentially, when you think about the mortgage crisis, what happened is that there's some underlying issues, but essentially the underwriting criteria was flawed. And so the idea is, are these people going to be able to pay, either whether it be for their car payment or their house payment? And essentially what happened is people, because the economy, were not able to make those payments, which then made the mortgages essentially fail. And so they were basically bad investments. And so the credit risk that you have is, do you want to extend credit? If you're a company or an organization that's, let's take it since it was just the holidays. Most of your major shopping stores, whether it be Target or JCPenney or Macy's, they have their own credit cards. Well, they have certain type of underwriting criteria, and typically they're only, maybe it's $500 to $1,000. They're not huge amounts of credit that they're lending, but there is that credit risk that they take on that after the holidays, maybe some of these people will not be able to pay. And so that is a risk that they take, that they're deciding to allow someone to purchase a product that's only from their stores, and essentially they're taking out a loan, in this case a credit risk, for that. And the same thing can also happen with suppliers, that if you're a hardware store and the main, and you're a franchisee and you need to order product, you're going to be extended a certain line of credit, and hopefully you're going to have the ability to pay. And then finally, there's price risk. So price risk is different, quite a bit different. It's kind of almost similar to exchange rate risk in some ways, but price risk is potential for a change in revenue or cost because of an increase or decrease in the price of a product or an input. So if you think about price risk, the airlines are a perfect example. Is that again, how quickly can they change their prices to be able to react? Well, for the most part, the airlines, some were, because of the higher price of fuel, they had to raise their prices. And so then you had an increase, those that had to increase their prices saw a decrease in the revenue, essentially, because of the higher price they had to charge. Now, I always use Southwest as an example because they were one of the first airlines to actually do hedging way back. They're most sophisticated at it. So while everyone else was raising their prices and charging additional fees because of the volatility of the jet fuel, that they were able to hold their prices steady, and so they didn't see the change in revenue as much as the other airlines did. And so that's a good example when you think about price risk. If you think about other types of, when we talk about the price of a product or an input, there can also be a change in revenue because change in technology. If you look at electronics, there's a price risk of, do you want to enter into a market electronics when essentially the price point keeps on going down. Computer prices, smartphones, all those types of things. From a price standpoint, the margins are fairly razor thin now because of that. So, a change in input price can dramatically change whether a company is going to be profitable or not. So that's the idea of price risk when we talk about that. So now derivatives. So in the book, when we talk about derivatives, and we'll use the definition here, a financial contract that derives its value from another asset, such as a commodity, or that can derive its value from yields on another asset. So the S&P 500, or any type of derivative, essentially the futures or contracts. And so we talk about it with a derivative, again using the word that derives its value from it, is that we're buying a contract, we're buying a piece of paper saying that we're going to buy a futures, pick futures, or corn futures, or other type of that. What we're doing is we're buying the contract, saying this is the value. We don't actually want, the actual product. What we're doing is we're paying for the price. That's the derived value that we're trying to get from it. and we just want to make money off of it. And by doing this, it becomes a financial instrument. And we'll see how this really moves forward in a few more moments here. But it talks about there's forward and futures contracts. There are two of the major four categories of derivatives. And the forward and futures are basically kind of the same idea, as you'll see. So a forward contract is a contract that obligates one party to buy another party to buy and another party to sell a specific financial instrument or physical commodity at a specified future date and price. And this would be the simplest form as it indicates of a derivative. So the idea is that we're going to take on such and such date, on June 1st, we believe the price of a barrel of oil is going to be, from a future standpoint, is $100 a barrel. Whether that's up or down, and that this is what we're going to pay, and that's the price. And so what's really happening, they're talking about on the oil, the price of barrel oil, it's all based upon speculation. And so that's where the contracts come in, is people are speculating based upon what they think production is going to be, whether there's wars, all those types of things are part of that discussion when we talk about about those contracts. Now, a futures contract, it is a forward contract that is exchange traded, openly available, and transferable. So the difference between a forward contract, it's really between one, I guess you could say simplest form it talks about is it's between one person and another person. Whereas a futures contract is the same concept, but it's actually, it's on the stock market. It's an exchange. There's a market for it. There's that anyone can buy it. I can sell it to anyone else. So I'm not stuck with it. With having this one type of futures contract, I can get out of the market and reduce my exposure. So that's really what when we talk about a futures contract, it's the same concept, but the idea is now you can go on the stock exchange or the various markets, or the commodity market, and basically be able to buy and sell. And again, that's where Southwest Airlines purchases jet fuel. And the idea of why would you want to do this? It reduces the risk of price fluctuations. It allows an organization to have that stability. In some cases, they may, on paper, maybe take a loss because they're paying more than they would have because the price went down. But if anything, it gives them that stability that they know for the next year they're going to pay this price for jet fuel. And then there's also what's considered an option when we talk about on futures. So as part of within a derivative area, you'll have an agreement that gives its holder the right but not the obligation to buy or sell an asset at a specific price over a period of time. And you want to know the difference between a call option and a put option. Call is you're going to buy at a set amount, where your put is going to be to sell. And you think about this on a stock. Some people have options. Or let's say people are offered a stock option, that they can buy under a stock option. Typically, as an organization, if I'm, it's a newer company, I may offer stock options to my employees that they can buy this stock at a reduced price, but they have to buy it at this date. As part of the requirements, typically, is an obligation that they have to hold it for a certain period of time, or they can't sell as many, or something like that. And so that'll be part of it. The other thing is on a stock, or even stocks in general, people can put a call or put on their stocks to say to the broker that at a certain point, if it reaches this price, they want to buy or sell. So if they see the price is going down, and they have a large holding, they don't want to lose even more. The concern is they're going to lose even more money. They might decide to sell at that point. So that's the idea between a call or a put option, is to give the opportunity for someone to be able to get out. Again, in some cases, it allows the holder the right, but not necessarily the obligation to have to do that. And then swaps, which is an agreement between two organizations to exchange payments based on changes in the value of an asset, yield, or index over a specific period. Now, this kind of goes back to we talked about credit default swaps and things like that. So the idea is that you may, depending on an organization, you're going to have an agreement in place that they'll basically trade some type of asset or an index, as it talks about. And there's really no money that's going to be paid up front, but the idea is that the cash flows might go back and forth. And this part is it talks about, why would you use it? And this is the main point you want to probably highlight here is it's, a swap is commonly used to manage interest rate and currency rate exchange risk. So that's probably the most important part. Not being a financial person, as most of the people probably that are taking the class are not necessarily in the financial industry. The swap is probably something we're probably not going to end up doing, but it's important to know what would be the purpose behind it. Now, it kind of shows an example in the book, and why LIBOR, which escapes me, but it's the international. You've probably heard about the LIBOR rates, which is the rate at which banks can borrow money, and we have the 1.5% in the first quarter, second quarter, and you can see that the interest rate's going up. Well, based upon that, there might be some fixed payments based upon that swap of whether an organization is going to, reap the benefits of a swap, and so it gives them really that the stability that they might be able to swap based on interest rates going up and help other organizations. But that agreement is going to happen before all this trading would occur, and it would be a prearranged of times that it would happen. And then last thing we'll be talking about for Chapter 9 is securitization. So this is the process of creating a marketable investment security based upon the expected cash flows from a financial transaction. So securitization, really anything can be securitized, essentially. And if you think about it, it's when we're talking about something that produces income. It could be some type of collateral base. So the good examples we've kind of talked about already is the mortgage. If the mortgage paper in this case that the banks have, they decided to securitize essentially these mortgages, and so they created these pieces of paper. The mortgage paper created it's an income creating type of paper, and it's collateralized so that if something happens, I would basically take ownership of the collateral if for whatever reason payments weren't made. Well, unfortunately, the underwriting wasn't done well, and people had a lot of bad paper they're holding on to. So as it mentions here, securitization allows exchanges incoming producing assets for cash. So why would you want to do this is because if you think about a mortgage over 30 years, which most people would have, over the next 30 years, if you look at the statement of how much interest you're paying, let's just make it simple that over a $500,000 loan, you're going to pay, $150,000 is going to be interest. That'll be generated. That's essentially income for the bank or whoever the investor is. Well, what I could do, if I have a whole bunch of these mortgages I hold, I'll securitize them. I'll make them as collateral. I'll bundle them all together and say, something, I want to take money now that I want to go ahead and get cash in hand. And so I produce all these things. Let's say there's 10, so it's $1.5 million. I can get a certain amount, whatever the amount of money is that they decide, based upon the market that they're willing to pay. And then the investors now would get the income from that, and I would get the cash in hand as part of that, and there'd be some type of investment arrangement. So the benefits to investors, essentially, they're gambling on a defined insurable risk event, not necessarily the risk of the organization. The rating agencies are typically involved in this process now. So when they talk, whereas before they probably, are these AAA rated? What's the risk essentially is what the credit ratings are basically saying. And then can be used to exchange income-producing assets for cash, provided the purchaser of the security, and assuming that a market exists. So if you think about it, there wasn't really a market for securitizing probably mortgages, 10, 15 years ago. Now you can pretty much almost securitize anything that you can have some type of way to do that. The other key point that they're going to talk about on here that they'll probably is what they call special purpose vehicle, or SPV. And it's as they describe, a facility established for the purpose of purchasing income-producing assets from an organization, holding title to them, and then using those assets to collateralize securities that will be sold to investors. And so the special purpose vehicle, or SPV, will enable a bank to convert mortgage receivable assets into cash. So again, the money that's going to be generated off of the receivables from people paying their mortgages will essentially is now collateralized to be able to turn it into cash where people can then invest, and hope, the goal is for them to make money off of that. So hopefully that kind of provides a context of the financial risk of what these type of things are. When we go into the next chapter here in a moment, we will be really talking about how does this kind of work from a hazard risk standpoint, what we're going to be looking at. So here's, as I always say, if you can describe it by the chart, then you'll understand it. So on this chart, what we're basically looking at is this, they call it generic securitization model. So an organization, a bank, insurer, or some other type of, most likely it'll probably be a bank or insurer, but they will have these assets that are making money, okay? And what they're going to do is they're going to take these income-producing assets and put them in the special purpose vehicle, what they call a facility. This is all financial terms, but they're going to kind of put them I guess you can say arm's length away, and put them in this, this vehicle essentially for the purpose of, being able to collateralize them. What then happens is these securities are then sold to investors now. Now they're considered, these income-producing assets are now considered securities, and they're backed by the income-producing assets. So these securities that are being sold are being backed by the money that is being collected from the mortgage payers, and then the investors basically will purchase these things, and they'll give cash to the special purpose vehicle, and then basically it makes its way back to the organization. So, from just a very basic sense, just to have an understanding of that. For the testing purposes, the main thing is just to understand what the differences are between, derivatives and securitization, and really know the vocabulary more than anything, at least for Chapter 9, because as we go into Chapter 10, we're going to use that same vocabulary with most of the questions that will be part of that. So now moving to Chapter 10. This is probably the one that scares most people, just because of the capital markets and a lot of things that are talked about in here. So obviously we'll spend the most time on this piece. So on the objectives for this one, a little bit longer list, but I think hopefully we'll try to keep it as simple as possible. So first we need to describe the types of capital market products that can be used for risk financing. And then be able to explain how insurance-linked securities operate in terms of the following: catastrophe bonds, benefits to investors, and advantages, disadvantages. And so we're basically, going to be looking at each one of these different types, explain insurance derivatives operating, including the use of swaps, and then the use of insurance options, and the advantages, disadvantages. And the next one, explain how contingent capital arrangements operate. So what would a standby credit facility, contingent surplus note arrangement, and catastrophe equity put arrangement, and again, advantages, disadvantages. So you can kind of see, mainly on this, you want to know the advantages, disadvantages of all these different types of instruments, and you want to focus really on the catastrophe bonds, the swaps, insurance options, and then on the contingent capital arrangements, the standby credit. It's also, if anything on this page, is to highlight which categories these fall into, to understand that standby credit facility is part of a contingent capital arrangement. It's not part of a derivative. You want to be able to make sure, again, 50,000-foot level, where do these things fall in? And then analyze the concerns of organizations that use insurance-linked securities, and to be able to describe some regulatory and accounting issues involved with insurance-linked securities as part of that. So, types of capital market products. So these are some of the things we've already kind of talked a little bit about from the prior chapter. Is capital market products are traded financial instruments, again, stocks and bonds, that mature in more than 1 year. So we talk about capital market just like a capital improvement. Think long term, it's more than 1 year. That's the idea when we talk about capital markets. And it's used to finance risk as an alternative to insurance. And the whole capital market, for those that signed up for the advising, if you haven't, you'll find a lot of news on this, and there's actually some articles I think I sent out prior that even had some links on this, that what they're seeing is capital markets, alternative risk financing is becoming more popular, that you're seeing more and more of this than people buying traditional insurance. and hopefully you'll be able to understand by the end of the night of why they're doing that. So again, used to finance risk as an alternative to insurance because it's now being seen as an investment by others, and was typically once used only to provide capital to insurers to underwrite their customers' risk. So where it was only used by the insurance companies prior, now it's even being used by other organizations outside of insurance, that they're looking for other investors to basically buy into some of the risk that they're taking on. So when we talk about capital market products and the things we're going to talk about, the three major categories are insurance-linked securities, the insurance derivatives, and the contingent capital arrangements are the three, and then there's going to be some subcategories under each of those as part of that. So when we talk about insurance-linked security, well, what is that? It's a financial instrument whose value is driven by insurance and or reinsurance loss events. So, and I think the examples they give are pretty good in here. The insurance-linked security is the idea that people are, for lack of a better term, they're going to Vegas and they're betting that a major catastrophe will occur or not occur over a certain period of time. And the example I think is given is, no higher than a Category 3 or 4 hurricane or an earthquake of a certain seismic level, things like that. And if there's not one, then the investors win. If there is one, then they're not going to win. They're going to have to pay out. So from a loss event standpoint, it's a marketable instrument based upon the cash flows that arise from the transfer of insurable risk. So instead of people actually paying premium, what they're doing is they're buying this investment. And so they're going to be collecting this money. It's going to be somewhat similar like an insurance premium, but that's how they're collecting the money. The challenge as we get near the end of the chapter here is this insurance or not? Because it kind of acts like insurance, but it's not within the state. Most states, they have premium, risk premiums that need to be collected, things like that. This is being seen as an investment. So I think the key thing to keep in mind when you think about all these things in this chapter is that there's much higher risk involved with, from the capital markets aspect because it's not your traditional insurance. It's alternative risk financing to do this. And as it mentions, mainly catastrophe bonds. So we'll talk about, really focus on the catastrophe bonds. So a catastrophe bond is a type of insurance-linked security that is specifically designed to transfer insurable catastrophic risk to investors. And it's going to be used by large reinsurers or corporations. And it's going to basically mimic traditional catastrophic insurance. Now, it's intended for rare and infrequent events. So, so I gave the example more like Las Vegas betting, where a rare catastrophic event will occur, such as a 100-year flood, Cat 4 hurricane, things like that. And essentially, that's what people are betting on. And the example that they provide here, I'm not going to go through the whole the whole type of thing here, but just point out that how this might work is that they see as a Category 3 or higher hurricane that affects. Okay, so the property insurer is a financially strong A Category 3 or higher hurricane that affects a densely populated area in the insurance coverage. Could result in over $1.5 billion in paid insured losses for the firm. The insurer decides in this case, therefore, wants to use a risk transfer mechanism that will reduce the variability of its financial results from one year to the next due to catastrophic events. And decides not to do reinsurance. And part of the reason why they decide not to do reinsurance is because previous hurricane events reduced reinsurer capacity and increased the year-to-year volatility of the cost of the reinsurance. So it made that reinsurance market go up because of that. So they're finding that there's not enough capacity, and so this is why it's considered an alternative in this case. So they use a special purpose vehicle and issue $500 million in 3-year catastrophe bonds to, in effect, reinsure its Gulf Coast and southern eastern hurricane risk. So this is the key point here. The bond investors lose interest and principal depending on the bond series. If a Category 3, 4, or 5 hurricane causes insured losses to the property insurer in excess of $1 billion during a 12-month claims period, the property insurer in turn receives reimbursement for any catastrophic losses from the special purpose vehicle. The bond offering is fully subscribed by the investors. So this $1 billion that they're collecting is from investors. So if there's no hurricanes, the investors are they make a lot more money on this. Otherwise, all the investors essentially, they're putting in they're almost acting like the insurance company because they're taking the money in. That money's being held, and essentially it's a roulette table in this case. But I think the example that they give, if I would read this example, because I think it really does provide a good case study of what we're talking about on insurance-linked derivative and how this might work. I would not expect, as far as a question, it's going to be asking, how would it work? What type of event would you may want to use an insurance-linked derivative? Something high level like that. It's not going to have you do the math and those type of things. So the advantages, disadvantages. One of the main advantages it talks about even in the example, it creates additional risk transfer capacity, and also lowers the credit risk. And the reason it says obligations are fully collateralized. The reason why it's fully collateralized is that they've collected all the money from the investors. So that money, the $1 billion, is sitting there to pay for the potential claims. And it's still going to earn some interest as well. But the idea is that the credit risk of people not paying, so we talk about credit risk of people not making their mortgage payment or other types of things, is this money that they already have cash in hand. It's when they have an insurance-linked security. Disadvantages, exposure to volatility of markets demand. As we've kind of seen, the market can go up or down, and you need to make sure there is a market first. There's also opportunity cost of collateralized assets. Is that if you're going to be putting some type of collateral as part of this insurance-linked derivative, that that may earn more money doing something else. So there's that opportunity cost of kind of setting aside these dollars in an insurance-linked security. There's transaction costs in setting this up. People have to get paid to basically set up the whole securitization aspect of it. And then finally, basis risk, which is the amount an organization receives to offset losses, may be greater or less than the actual losses. And it talks quite a bit about basis risk in there. So the question someone asked is, who would be potential investors in insurance-linked securities? I would probably say the investors are going to be your big investment bank firms. It's typically not going to be your small, mom and pop investors. But typically, and this is the whole aspect of, we talked about securitization and derivatives and the mortgage, all the things that happen in the mortgage crisis, is that those companies that are buying these things are typically their investment banks or their investment holding companies. And the concern is that they're using these dollars from people that put money, well, traditional banks were also doing this investment, and so they're putting your and mine dollars at risk, and by investing in some of these things that are much more risky than traditional areas. So typically it's going to be your institutional investors, essentially, are the ones that are going to be investing in these type of things. But yeah, that's a great question. And that's why there's the increased, so kind of going back to, I think in ARM 54 we talked about, Basel II, Solvency II, and all those. Basel is for the banking industry, Solvency is for the insurance industry. And the concern about where this falls in, and this whole discussion at the end of the chapter is this insurance? Should it fall under the insurance rules, or is this banking? Investment, should it fall under investment and banking? And it's kind of it's a black hole at this point. And that's why you see, the Dodd-Frank and all those type of things was intended to address this issue and to help provide some more, reduce the risk to, everyday investors or people putting their money in banks. That was part of it. All right, so the other aspect, so now moving on, we talked, first was insurance-linked securities. Now we're moving on to insurance derivatives. So insurance derivative is a financial contract whose value is based on the level of insurable losses that occur during a specific period of time. So it increases in value as specified insurable losses increase, and this can be done through financial contracts based on insurance derivative concept, which includes swaps and insurance options. Now, when I read this, and this is probably the part that it takes a little bit more to understand, is the increases in value as specified insurable losses increase. So basically, the more, I guess you could say, more money is collected through the swaps and the insurance options of at what point these things are being purchased. And so hopefully these next, I think the example they do give in here provides a decent example of how this might work. So we do have another question. So the question was, what agency regulates the insurance derivative business? The local state insurance department or federal agency? Another good question. No one really regulates the insurance derivative business. That was the whole idea of Dodd-Frank. So state and insurance department, and that's the issue. So the kind of question going back to insurance, or basic legal securities is that that they're not considered, depending on where you're at, whether they're insurance, and so that's where the lawsuits are coming as, what are they? And so that's really where the questions come up, and because they're different. So I unfortunately I don't have a really good answer for that, other than to say that's why I would say in Europe you're seeing much more regulation of it, and in the U.S. there's much more hesitancy, being seen as anti-business to regulate essentially in these type of areas. So back on the here's a swap example that was given in there that basically kind of talks about how, again, I'm not going to read it, go through the whole thing, but in this case they created a swap where they have a pool, and this is where they basically kind of swap the risk. So there's a $110 million pool arrangement, provides the Caribbean Catastrophe Risk Insurance Facility with capacity to serve its claims based on its own reserves. The first layer includes retention of first $10 million of claims. Second layer is reinsurance. Third layer is reinsurance, $24 million. It talks about all these different reinsurance layers, which hopefully makes sense now that we've gone through all the how reinsurance. And a $20 million at the very top, a $20 million catastrophe insurance swap between the World Bank and the Caribbean Catastrophe Facility. In conjunction with the swap, the IRBD, which is the International Bank for Reconstruction, established a catastrophe swap with Munich Re Capital Markets to shield its reserves from catastrophe risk. And they consider this the first transaction to enable emerging countries to use a derivative transaction to access capital market to insure against natural disasters. And it gives them immediate access to cash and so on. They really don't describe how the functioning, but this was the very first one from what they described in the book as being part of that. From a testing standpoint, just understand that a swap is part of an insurance-linked derivative. There's not going to be much detail on that. And then on an insurance option. So an insurance option is probably, I would say, probably used more from a derivative standpoint. And even though they give an example about a plumber, but the idea would be a ski resort or a large, we talked about a large organization, but not probably necessarily a small plumber would be taking out an insurance-linked derivative. But the idea here is that if you use rain as the example, that if I'm a contractor and that derives that if there's more rain, that means there's more work because there's damage in this case. For this basement repair contractor, he'll purchase a weather put option based upon the measurement of rainfall at the nearest weather station. And so there's a specific time period, a specific amount or location that has to be done, and so it's objective. That's the one key advantage of this. And so normally it says the average precipitation for August through September is 7 inches. The insurance options put strike price is set at 5 inches. So basically, so the put option is designed so that for every inch of precipitation below the strike value, so every the option increases in value by $10,000. Precipitation cover is written as an insurance policy, has a limit of $40,000. So it's written as an insurance policy for this derivative purpose. And if cumulative precipitation between August and September is only 3 1/2 inches, okay, so it's the put, if we look back, is 5 inches, but it's only, and so it says only did 3.5. That means there's only 1.5 was below. So his risk now, based upon this policy, is that he would receive $10,000. So 1.5 times 10 is $15,000. So So the idea behind this is that it helps minimize the risk that he's going to lose income. And so the idea is, who'd be willing to, is there a market for this, first of all? You know, is someone willing to do this insurance option for this person? Usually you'll find this probably more in agriculture, or maybe, you know, for California now, you know, in the Sierras, we don't have much snow. And so you'd most likely see ski resorts. They would probably have an insurance option that would basically say, look, if we don't get this much snow, based upon what the average is, that they would they'd be able to purchase this. Now, the thing to keep in mind in this example is they don't tell how much he paid for this coverage, and it's going to be market-based. You know, what someone's going to sell for, what they think, and it will change from year to year based upon what the underwriters believe. So, whether it's a good deal or not, I can't say by reading this, but that's the example. The main thing is to understand how an insurance option works. And this is an example, I think, with it's a fairly simple example, but hopefully that gives you some good context of how that would work. So I think that, you know, good example of how these things are different from an insurance policy. So under insurance policy, premium is paid by the purchaser prior to the policy inception. Again, in this case, we're talking about a contract, so the premium is paid by the purchaser at the beginning of the contract term. So again, we're using the word, you know, premium, which, you know, and then we're talking about a policy, so we think about insurance. A deductible self-insured retention can apply to a single occurrence. In this case, we talk about a strike price can apply to a single event, or regular time periods, or to the average of full experience. Depends on what the contract says. What you're buying, you can put anything into a contract, and so it's much broader what you want to write this contract for. The purchaser is indemnified by the insurer if the level of insured losses exceeds deductible or self-insured retention. So when we talk about indemnified, if I buy a policy saying if I have a loss, I'm going to be made whole again after my self-insured retention. In this case, an option has a value only if the underlying asset or index exceeds the strike price. Only then will the purchaser exercise the option for financial gain. So, you know, there's nothing there. And then there's a policy limit typically, and then theoretically under an option contract has no limit or payout. So if you said that we would expect to, you know, from a certain price, depending on what the contract says, you know, that we're going to have so much rain or so much whatever, depending on how the contract is structured, I can keep on paying if we just kept on having, you know, whatever the event might be that was at the strike price. So again, I think this is a good chart to take a look at for studying on this chapter. So advantages, disadvantages. Again, I think the advantages to all these that you're going to see is additional risk capacity. It allows, you know, when the market is, because of the risk taken on by reinsurers, it provides an alternative means. You get a different group of investors involved. You know, again, if you think about when you buy insurance, what's happening is I'm paying a premium to get that coverage. These insurance derivatives and these capital markets, people are investing in with the goal of making money. So that's really the difference when you think about what's going on here, is that from a capacity standpoint, we're talking about a different group of people that are putting their money in. Lower in cost in insurance-linked securities. So insurance derivatives are lower in cost than insurance-linked securities. There's going to be transparent pricing, typically because of the market that's going to be based out there. Opportunities for investors to exit during its term, which basically means that I can sell my contract to someone else, and they take on the risk. So, you know, just like a piece of paper that I can sell, you know, with an insurance policy, you're stuck for the entire year. You bought the policy. With this, as an investor, you can get in and out. There can be standardized contracts and efficient claims and contract settlement. The reason why the efficient claims and contract settlement is that within the contract, or the swap, it's going to be very specific and say, if this happens, this interest rate, this, you know, much rainfall, I will pay you $5,000 per inch or whatever. So you're not dealing with fault. You're not dealing with, you know, all those type of things. You're just dealing with very objective data that is agreed upon in advance of how those things will be done. So that's the idea of some of the advantages. Some of the challenges with it, underdeveloped markets. I would say the plumbing market that's described in there is probably underdeveloped. This is a new area for insurance derivatives. You're seeing more of it. The basis risk, again, that the amount of money that's collected for it, the credit risk of people being able to pay. You need to, because this is a contract in this case, that they only pay in the event of this event happening. It's not collateralized up front. So that's why there's credit risk, is you have to make sure that whoever you're doing the contract with has the sufficient means and resources to make sure to pay in the event a claim does actually happen. And then uncertain regulatory and accounting treatment. Again, this goes back to the question of who regulates. Well, is it insurance or is it investment? Well, and then also there's the issue of tax, a taxable event, those type of things. Is it liability on the books? There's a whole bunch of questions that go along with that. And then I think this last one on the contingent capital arrangements is actually probably, hopefully, the easier one to understand here. So under a contingent capital arrangement, it's an agreement entered before losses occur that enables an organization to raise cash by selling stock or issuing debt at a prearranged terms after a loss occurs that exceeds a certain threshold. So the idea is that, as contingent capital arrangement, that it's an agreement with a bank or an investment firm. And what you're basically doing, instead of with insurance, they're saying, okay, we're going to indemnify you, we're going to pay for these losses that occur. What you're saying under this is that if you have a certain amount of loss, that you have access to capital. You essentially have access to borrow money. That's all that we're doing in this case. That we set aside stock that this company will automatically buy the stock, and so they'll have some ownership by having this contingent capital arrangement done. And so they're agreeing to, whereas maybe they wouldn't buy it because the stock maybe is going down, but they're going to have to buy that stock at that prearranged price, and this is all done before an event may occur. Question, are there derivatives used in the entertainment industry? Example, the investors for Michael Jackson. Yeah, I would suspect that was probably, well, because I guess, yeah, I think there is, because that was an investment. Was it AEG, I think it was, the entertainment company. I would suspect that was part of the issue, was whether he was going to be able to perform, how much money. The collateral being that he was going to perform so many shows. That would surprise me if that was some type of derivative arrangement that was done. And again, it's an investment, and then people are taking a gamble, and the expectation is they're willing to front a certain amount of money to help put the show on, and expect a certain amount of return, so they take that risk in doing it. But yeah, I think that would probably, most likely there probably was something there. I'll see if I can't look it up after the class and get back to everyone on that. So when we talk about contingent capital, so again, the idea is that, an event happens, either the bank's going to loan us money at a predetermined interest rate, or we have stock that we have common stock that a company or a bank is going to buy at a certain rate, even if it's, we set a price. Let's say the stock went down to $10, but they agreed to pay $50, then that's what they're going to pay, because that's part of the contingent arrangement. And then it also talks about notes here. So standby credit facility, arrangement in which a bank or other financial institution agrees to provide a loan in the event of a loss. Okay, that's down, it's self-explanatory. A contingent surplus note, it's notes that can be sold if needed to obtain cash at a pre-agreed rate of interest. So again, the notes basically being there that they're already done. Whereas the standby credit may not have depends on what the amount is. But then we have the interest rate on the next one. And the last one, catastrophe equity put option, which is the ability to sell stock at predetermined price, which is what I described earlier. So here's a good example of how this might work. Why would you want to do a standby credit facility compared with excess insurance? And this is why it's attractive maybe for a large organization, is that if you look at standby credit, what they want available in standby credit is $10 million, and excess insurance, they can get $10 million policy, essentially saying if they have a loss that exceeds a certain amount, they're going to be, that layer is going to pay up to $10 million and to indemnify them, basically. So under standby credit, they would have to pay a $5,000 commitment fee prior to loss, to loss payments. So basically, to have this agreement each year, let's say it's going to be $5,000. Excess insurance, I'm going to be paying $200,000 a year in premium. Okay, and so that's the loss there. Here's the standby credit. They're agreeing to interest rate, if needed, a 5% will be the rate that's predetermined. So even if interest rates, determine how long the agreement is, are 10%, they're going to do it at 5% for me. Of course, under excess, you're not going to have, it's not a loan. You pay the premium, that's what they're going to pay. And then the length of loan, same thing doesn't apply. In this case, you have to agree with this up to $10 million you're going to pay back in 15 years. So what they talk about here, and this is where I think the example makes the most sense, is that the largest possible cost in the first year is that if you had to take out this full $10 million at a 5% interest rate, and then you had to pay back in 15 years, the largest possible cost in the first year is going to be $700,000. And I go, well, I'm only paying $200,000 over here, so isn't this a better deal? Well, you have to remember that you're paying, in this case, $200,000 a year for the next 15 years, whether you even use the policy or not. And so, so you're paying essentially what, $3 million over the course of 15 years for this coverage, for this $10 million, and you may never use it. And so, could you put that money? So it's kind of somewhat of an opportunity cost. Now, again, in this case, the credit facility, you're $700,000 a year over a period of time. You're going to have to end up repaying it, but it kind of gives you an idea of, well, what's the risk? What do you feel is worth doing? Can you sleep at night? Type of aspect. But it basically kind of does the same thing. It gives you capital that you would need in the event of a large loss, and with agreed upon terms. In this case, you're getting a loan compared to having excess insurance just basically pay the one time. And also, if you did do this and you actually did have a loss in the first year, yes, you might only pay $200,000, and then the next year, your policy is going to go up, most likely. So, advantages: lower additional cost of making funds available to an organization per year, as I kind of showed. By doing that, capital infusion at a predetermined price, so we have that. The disadvantages, loss sensitivity, and then ownership dilution is that, there might be, because of stocks or how things are done with that, in order to make that happen, you may lose some of the dollars as part of that. And this, actually, the ownership dilution deals more with the catastrophe equity put option, is because you're basically, if you're going to sell the stock, you're basically diluting the ownership because you're allowing these people to buy at a predetermined price. So that's where that can be part of it. The other disadvantage, they talk about loss sensitivity, is the moral hazard, that people may not be as concerned with losses, because they know that they have this capital arrangement that they might not be as careful. At least that's concern as part of that. So there's more discussion in the book on the standby credit and contingent. I think as long as you understand how these, three things, the main pieces of them, that these are all part of contingent capital arrangements, you'll be just fine, and understand that it's really a loan that's going on compared to insurance. So concerns. This is the last couple items in the chapter here, and one thing they talk about. Concerns for transferring capital. If I'm the organization that's transferring the risk, not the investor, so I'm the organization that's going to transfer. There's three main concerns I have: cost, the financial security of the credit risk, meaning, am I going to get paid, and then also the basis risk of, am I going to collect enough money to actually pay for the claims that might be there. And so this chart kind of shows the various where things are kind of put in here. So if you look at the financial security, these things that have high financial security, traditional insurance, reinsurance, I have pretty high financial security, and based upon actual losses, this is where this comes in, and the basis risk, I know that I'm going to have enough money to, to pay the claims. I'm going to collect that, and so it's also very low, for financial security, everything. I'm pretty good with traditional insurance. As we move over, you can kind of see where these things kind of move over to this corner, standardized exchange-traded options or insurance-linked securities. Why there might be some financial security looks fairly high because it's collateralized. Again, that's why there's financial security on this side. But the basis risk, I may not have enough money depending on the market. And then as we go forward for forwards and futures, is that the financial security is not as high, a little bit lower because it's not as stable. It's based upon market forces, what other people are paying and what people are willing to pay for that. But it will be based on an objective index or type of trigger. But the thing is, I may not have enough money to collect enough money to pay for claims. And then you go up to standardized exchange-traded options being even more market volatility, those type of things, as far as how those things might work there. So now this is the regulatory and accounting issues that people would be concerned with. And so I kind of, the last chapter, or right before the end of the chapter in the summary, it talks about this, the regulatory and accounting issues. So the main issue that's really being discussed is whether insurance-linked securities derivatives should be regulated like insurance. And so if you look at that, if it's treated like insurance, then state insurance regulations, and you have premium taxes, and then also you have to, the accounting for liabilities that, the types of losses would have to be accounted for. If you don't treat it like insurance, then if the idea is, well, it's an investment, shouldn't it comply with SEC regulations? Again, if you think of insurance, if you put money into an insurance vehicle, it's now considered a business expense. It's tax deductible. Well, investment dollars that are lost may not be, from a deductibility standpoint, may not. And then also the concern of, do you record losses on the balance sheet? Are these considered liabilities by having these type of things? So, so the last, section that it talks about in the book is really kind of looking at, what are some of the concerns that you need to be with these type of things? And the reality is that there's not really any good answers. That this is an area that's kind of really still in flux, and the lawsuits, there's a lot of, lawsuits now being filed. And if you think about, was it Enron and some of these other companies, why we got to where we were with Sarbanes-Oxley, it's a large part because of some of these investments and how they were doing these things and recording whether these things were profit or not. So a couple questions were, what types of companies today are most likely to be using these alternative types of risk financing? So actually, I would say that most likely you're probably still going to see the reinsurance markets are probably looking at some of these type of vehicles on alternative financing. The Advisen, if you do a search on Advisen and just do a search for alternative risk financing or contingent capital, you'll actually find probably quite a few stories. And there was a recent story they talked about that what they're finding is this is definitely a growing area, that the amount of capital or amount of infusion of new investment dollars is growing, and as people are getting more comfortable with the idea. So, but, it depends on the type. I would say on the contingent capital arrangements, that's probably more common. Your large, very large organizations that if they have a huge loss, that they're going to have contingent capital, or even probably, maybe even medium-sized. Actually, if you think about it, a lot of companies probably, they don't know they're doing this type of risk financing technique, but if, well, actually for homeowners, this is where people can get in trouble or not, is a lot of people, home equity loans, where you get a line of credit. If you think about it, it's a contingent capital arrangement. Now, we're not necessarily using it for a loss per se, but it may be if you have a major purchase or you have some type of arrangement that you're going to have the ability, you don't need to, you can determine when you want to take the money out, and it's preset at a set interest rate, and a certain amount you can max out. You can borrow all of it or a little bit of it based upon the contract, but when you think about it, that's really what a home equity line of credit is. or a line of credit for other types of things. It's just the difference is how it's being used, and I think that's probably the best example I can get. And then the other question, it looks like, goes into types of risk versus traditional insurance. I mean, there's always going to be the role for traditional insurance, but I think what you're finding is that there's always going to be some creativity within risk management, and that's why you're really seeing the changes that within the insurance industry. There's always some new product that's coming out, and I think you're going to continue to see that with some of these type of losses here. So we actually ended a little bit early tonight. So again, if there's any other questions, I'd be certainly happy to answer those. Hopefully I made more sense of this chapter for those out there. I know it's one of the more challenging chapters since it's not traditional insurance, it's more on the financial side. And encourage those folks to go ahead and email me questions. I'll be happy to answer those. So thanks again, and Happy New Year to